Credit cards are common financial tools used by individuals and businesses to make purchases and manage expenses. However, it is not used responsibly that can also lead to debt and financial difficulties. To avoid these risks, it's important to understand how credit cards work and how to use them responsibly. Credit card work by allowing you to borrow money from a lender to make purchases. The lender charges interest on the balance owed, and you're required to make monthly payments to pay off the balance. While applying for a credit card, it's important to review the terms and conditions carefully. This includes the interest rates, fees, and other any rewards or benefits that may be available with it. While using credit card, it's important to only make purchases that you can afford to pay off. It can be tempting to use a credit card to make purchases that are outside of your budget, but by doing so, you can lead to debt and financial difficulties. To avoid carrying a balance on your credit card, it's important to make payments on time and it in each full month and in full each month. This will help you avoid interest charges and ensure that you are using your credit card responsibly. To use a credit card responsibly is important to us. Only make purchases that you can afford to pay off. Make payments on time and in full each month. Keep your credit utilization ratio low. Monitor your credit card activity regularly for a fraudulent charge. Credit cards can also offer rewards and benefits such as cashbacks or points for travel. However, it's important to only use these rewards programs if you are able to pay your balance in each month. Otherwise, the interest charges can outweigh the value of the rewards. Monitoring your credit score and credit report regularly can also help you use credit cards responsibly by keeping track of your credit score. There are several types of mortgage available, including fixed rate mortgages, adjustable rate mortgages, interest only mortgages, and balloon mortgages. Each type of mortgage has its own advantages and disadvantages depending on your financial situation and goals. Fixed rate mortgages have a fixed interest rate for an entire term of loans, which means that your monthly payments will remain the same. Adjustable rate mortgages, or the other hand, have an interest rate that can change over time, which means that your monthly payments can fluctuate. Interest only mortgages allows you to pay only interest on the loans for a certain period of time, while balloon mortgages require you to make lower payments at the beginning of the loan term, with a large balloon payment due to the end of the term. Considerations while getting a mortgage. When getting a mortgage, there are several key considerations to keep in mind. One of the most important is the credit score, which will play a major role in determining your rate, interest, and overall loan term. You should also consider your debt to income ratio, which is important, um, or the amount of debt you have compared to your income. Lenders typically prefer borrowers with low debt to income ratio, as it indicates that they are less likely to default on their loan. If addition, you should consider the down payment you can afford to make, as well as any other costs associated with buying a loan, such as closing costs and property taxes. In conclusion, a mortgage is complex financial products that require careful consideration and planning. By understanding the type of mortgage available and any key considerations when getting a mortgage, you can make an informed decision that best meets your financial goals as needed. Now